Okay, we are live. Right, let's begin. Welcome to another weekly market analysis. My name is Gavin. This is an Alphachain webinar. It is Tuesday, the 9th of August, just past 11 a.m. UK time. We'll have a quick review of what's happened in the prior week, and then we'll discuss the week ahead. As the title suggests, the focus is going to be the US inflation report midweek tomorrow, Wednesday the 10th. So that's where the sort of key focus is going to be. But hey, let's have a recap of what's happened so far, so you are up to date of everything market moving. Okay, so let me just come over to the economic calendar. Yep, you can see the economic calendar. Ensure we're on last week's view. Okay, so before I go into and break down all this sort of key macro events that occurred last week, the high impact events, just as a reminder, we know that the markets had interpreted Fed Chair Jerome Powell's post-meeting press conference, which had taken place between July 26th and 27th, their policy meeting, as a dovish pivot. Okay, and that's led to other, sort of, especially last week, around several Fed officials. They began to push back against that dovish narrative and indicated that the central bank is still steadfast in raising rates until inflation is under control. Okay, so from 2 weeks ago, we had the Fed come out raising rates, but that's not where the focus was. It came in line as expected, but the focus began is where Jerome Powell, in his press conference, who had shifted his rhetoric from not just having inflation in focus, is to now look at incoming information going forward before deciding whether to raise rates further in September onwards. Now that gave the markets some inclination that, hang on, inflation is not the only worry now. A recession is potentially a worry, and that's why we need to review incoming data, and we're now more data dependent, not just inflation dependent, shall we say. But coming over from last week, as a review of a number of Fed speeches, we saw them come back in line with inflation being their key focus at this current moment, especially this week as we do have the CPI data being released. Another key element that's not in the economic calendar that I'm going to cover in a minute or so was one of the key focus from in the sort of early part of last week was House Speaker Nancy Pelosi's visit to Taiwan. And I believe it's after the US has been over to Taiwan after around 20 years or 20 plus years, 25 years, I believe. So this is the first time a US representative of the administration has headed over to Taiwan. And this actually raised US-China tensions, right? So there's some rhetoric going back and forth between the two. In addition to that, we saw the largest military drills from China taking place in the Taiwan Strait, right? So just around and almost surrounding Taiwan itself with their ships where they're located. So, is there going to be diplomatic talks or is there going to be a continuation in this tension? And is this where China are now looking at Taiwan as the next step in their way of controlling the Taiwan Strait, right? So, yeah, so we'll wait and see sort of what takes place from a geopolitical standpoint, but that's one of the key events from last week. Now, coming through the economic calendar, we're going to focus on high impact data only. Those tend to be the ones under the impact column, the ones in red. Okay. So the beginning of the week, we didn't have much information coming through. It was Tuesday overnight. We had the first high impact event, which was the RBA, the Reserve Bank of Australia, rate statement, okay, as well as the cash rate decision, the interest rate decision. They had raised rates from 135 to 185, okay, so 50 basis point rate rise as expected, in line with the expectations. And this is just showing you how quickly they have ramped up their interest rates most recently since May of 2022. So at a rate rise in May 2022, and then another rate rise in June, July, and now, of course, August as well. So back to back, we've had rate rises, and initially started off with a gradual 25 basis point. Now we've seen most recently a 50 basis point rate hikes taking place. In addition to that, Tuesday afternoon in the US session, we had the job openings. Okay, now this came in at a lower clip amount. Okay, so this is, as you can see over here, this is the number of job openings during the reporting month. It excludes the farming industry. Okay, excludes the farming industry, and it's reported by Bureau of Labor Statistics. So just looking at sort of prior numbers. Okay, so prior numbers, you can see there 11.25 mil. 11.40, 11.55. So they're also above the 11 mark. This time, it came in, even the forecasted was lower than previous forecasts that have occurred. So there was a view that the labor force may be beginning to slow down in the US, okay? And that's what this indicated. It came in at 10.7, right? So just looking at this, you can start to see now there's a decline emerging in the jobs, okay? There's a decline emerging in the jobs. Now, that was obviously taken towards the end of the week where we had obviously non-farm payrolls. So the anticipation going into the Friday non-farm payrolls is that we're going to see a slowdown in growth. But hey, we know what happened there. I'll give you a reminder in a minute or so. Okay, moving on. We had some employment data from New Zealand, and that unemployment rate came in at 3.3%, so slightly higher forecast than the forecast. The previous is 3.2. It was forecasted to drop to 3.1%, but actually came in a little bit higher at 3.3%. And there's some fear of recession certainly taking place in Kiwi, in New Zealand, when it comes to looking at the Kiwi. Okay, this is one of the speeches that I mentioned. FMC member Bullard had spoken around that time. Okay, moving on. For the Swiss, they had their CPI data. The CPI data came in at 0%, so slightly higher than anticipated. But again, the focus wasn't there on Wednesday. The focus was across the board. We had services PMI data being released. That's across the globe, okay, across the sort of globe. Now, just to sort of mention there what this is the level of a diffusion index based on surveyed purchasing managers in the service industry. Okay, so it's a survey by purchasing managers of the service industry, how that is performing. Okay, now anything above 50 is expansionary, below 50 is contraction. Okay, so just looking across the board, you can see in Italy, it came in below the 50, so it is contractionary. Okay, whereas the rest of the sort of, numbers came in okay. Okay, German numbers came in slightly better, even though it's in contraction than the forecast. In the Eurozone entirely, it came in at 51.2, so a much better number there. But it was the US ISM service PMI data that was a big surprise in a positive way. Okay, so the forecast was 53.5. It came in at 56.7. That really did boost the economy, boost the markets based on this information here. Okay. In addition to this, we did have the OPEC Plus meeting that had taken place. What we're going to hear is that OPEC have given us indication in the last few months that they're going to raise their production levels at a certain amount every single month, right? And there was obviously in the last few weeks, we had seen Joe Biden, US President Joe Biden, head over to Saudi Arabia, have meetings with oil ministers and Saudi sort of princes as well, and sort of wanted to really promote the idea of raising their production levels, as the US are doing their part where they are releasing some of their reserves, their oil reserves, their SPRs, right? So the question is that did Joe Biden really have that influence to be able to do that? Actually, it doesn't seem like that's the case, because the OPEC Plus, there's two elements to this. The first is, of course, the key point being is that they only raise their output to 100,000 barrels per day from September onwards. Okay, so we're going to see a gradual increase to their production there. Okay, so that's the sort of key point. That's their total production. And the sort of key element to take away from this is the decision it suggests the cartel is focused more on the specter of declining demand amid the recession warnings that we've seen recently, right? Then actually what the US President Biden wants them to do for greater output, to control the prices that we're seeing, right? So to bring down the prices that we've seen on gasoline and oil, okay? So it is also of note that several of OPEC Plus members also have struggled to ramp up production because of their aging infrastructure and, of course, some political turmoil occurring idiosyncratically within those countries. Okay, but more importantly, we actually saw the price drop lower, and that was because of the EIA. The EIA data showed a surge in stockpiles, which sent the price of oil lower. So the EIA followed the previous day's API build. And if we look at the 4-week rolling average for gasoline demand, we find it is below the 2020 levels. So with a small increase from OPEC Plus, there are reports the US and Iranian officials now would have some indirect talks regarding the potential revival of their nuclear treaty. Okay, so there is other ways that the US can look towards bringing down the price of oil if they have some sort of cooperation with Iran. Okay, so yes, oil was obviously of key note from the last week's Wednesday session. Heading over to Thursday, we had on the 4th of August, Thursday, most importantly, the focus was the Bank of England. Okay, the Bank of England. Now, we've seen that the Bank of England has raised rates in a step format of 25 basis points 5 times in a row. The question is, are they going to raise for the 6th time? And was it going to be a much higher amount, what was forecasted, of 50 basis points? And that's exactly what happened. So their previous number was 1.25%. They raised by 50 basis points to 1.75%. The vote went in favor of a rate rise. All 9 MPC members voted for a higher amount, but one came in at 25 basis points. 8 members voted for a 50 basis point rate hike. Okay, so that's sort of the key point to note there. Other key points to mention now. What actually happened is during the press conference thereafter, 30 minutes after this information came through, and if you actually look at the policy summary, the statement itself, even though we saw a larger rate rise, we actually didn't see the pound strengthening on the hopes of on the fact that we've raised base rates by 50 basis points. It was the inverse, and it's due to their forecast. Okay, it's the way they came across with their tone, the tonality from these members, these central bankers, right, is very important. Are they going to be dovish or hawkish? And we saw the same with the Federal Reserve, and now we're seeing the same thing occurring with Andrew Bailey and co. Now, the governor of the Bank of England, Andrew Bailey, specifically mentioned that there is a bleak outlook for the GDP, or going forward, the GDP levels, and rising inflation forecasts are set to reach 13%. Okay, so we could see inflation topping 13%. And the fact that we are likely to head into a recession by the end of this year. So by the end of this year, we'll be heading into a recession, and that could be a long looming recession of up to 5 quarters is what was mentioned, 4 to 5 quarters. So, that sentiment certainly dampened market confidence, and that's why we saw a bit of a sell-off occurring. Okay, a weaker sterling, a weaker pound. And then we head into Friday. Okay, Now, with Friday session, the entire focus was, of course, the non-farm payrolls. Okay, the non-farm payrolls. Now, Friday. Now, as I mentioned, right, sort of midweek, early on in the week, we sort of had began to view that there could be a slowdown in the growth in regards to jobs. Okay, in the labor force, and that was really what was anticipated. But actually, it came in at a much better result than hoped. Okay, so we had a high number of non-farm employment change, which came in from the forecast at 250,000, came in at 528,000. And do note the previous, if we look at the previous two numbers, right? The previous two numbers were also revised higher later on as well. So both previous numbers have been revised higher. And we may even see this one may be revised as well. But they both came in, quite positive, even though we saw a slower number, but they were revised. But this number really was a big jump. It was a big jump than the forecast. But in addition to this, it wasn't just this alone that really boosted the sentiment in the US. It was, of course, unemployment rate came in at 3.5%. This is reaching historical levels, right? So just going back to prior to COVID, okay, prior to COVID, the sort of lowest figures we'd seen then was in the region of 3.5%, okay? So, so we're looking at 3.6, 3.5 at certain stages as well. So 3.5% is what was met in January of 2020. And then we're back at these pre-pandemic levels, 3.5%, yeah. But in addition to that, we also saw average hourly earnings come in at a higher clip as well. So that came in at 0.5% and the forecast 0.3%, and the previous was revised higher as well. So average hourly earnings are improving, unemployment rate is moving lower, and we've got a large number of job openings occurring. It is seen the labor force is extremely strong in the US, okay? Now, do I have an image that I can raise here? Yes, no? Yeah. Oh, no, it's actually, that's not the one that I wanted to cover. Okay, so, yeah. So non-farm payrolls came in at a much improved than expectations. So what can we take away from last week? Well, we're seeing a divergence amongst these policymakers of what they've done so far and how much of that has had a positive or negative impact on the economy. And it just seems that the US are certainly moving to more towards a soft landing, but whereas the European and the UK markets are certainly facing a much more of a struggle with a hard landing of them raising rates, right? So has the Fed achieved soft landing status? Well, time will tell. It's a little bit early to say, but it is certainly looking more like that, right? Them raising rates at a much aggressive amounts previously has certainly led them to, ensure that one, they are certainly sort of, looking to tame inflation, and we're going to find out tomorrow if that's the case, okay? And some of the stats are showing that. But the other points being is that their labor force has stayed in force. So the labor force is obviously a much important number, and it's having less of a knock-on impact on the consumer demand. So we can see that through services PMI and some of the other retail reports that we've had from the US. Whereas in the UK and Europe, we're seeing inflation numbers continue, and we're expecting much more sort of larger numbers, double-digit numbers. Bank of England forecasting 13% as red hot inflation, and that's certainly going to have more of a negative connotation when it comes to recessionary fears now. Okay, so all three US major indices, if I come over to equity markets, maybe sort of look at the daily time frame. We might even look at the weekly time frame. Just looking at the sort of the weekly view here, we can see the last 3 weeks, we've seen 3 weeks of a bull run. Simple as that. Okay, so the last 3 weeks, the major US stock averages have modestly moved higher. Okay, modestly moved higher. Certainly last week was a bit of a mixed result, as you can see in the S&P 500. So not such a large bullish candle, but we can see, if I just point just underneath that, just about there, it's a small bodied candle, but it's still green. It's still positive. Okay, so we've had 3 weeks of a bullish tone. Now the question is that going to continue? That's sort of the key point there. Just to sort of refresh some of these European markets, we look at the FTSE 100, we're looking at the DAX as well. They have followed suit with that same rhetoric, but I do feel that there's going to be some divergence coming very soon if we see US inflation levels are improving, and then the Fed do become a little bit more neutral and data dependent, whereas the Bank of England and the ECB are behind and they need to now ramp up their rate rises and cause a hard landing, which leads to a recession. Yeah. So even though we've seen a bit of a bullish tone coming through in the last few weeks, but is that likely to continue? It's looking less so for the European markets. Okay. Now, moving on to the week ahead. So the week ahead, coming back over to the economic calendar. So you can quickly see where central banks are at the bottom of the hair. So Canada is ahead. Canada, Kiwi, and the US are all three are at 2.5% when it comes to their base rates. And over in Australia, they're at 1.85%. The UK is at 1.75%. Euros back above, they were at zero, neutral, right? Now they're at 0.5%. The Swiss franc also surprisingly raised rates by 50 basis points from going from negative 0.75% to now negative 0.25%. There's been no change in the stance by Japan, Bank of Japan. Okay, the week ahead. Now, the week ahead, surprisingly, over what we've seen over a number of weeks now, 6 to 8 weeks, is actually a quieter week overall. Okay, so there's not a lot that's going to be occurring for the week ahead. Yep. As I mentioned, the key focus is going to be inflation. Okay, so if you look through Monday, Tuesday, mostly low impact news, nothing to be too concerned about. It is when we go into Wednesday, tomorrow, is where we're going to have the focus being inflation reports. We don't just have inflation from the US, we will have inflation from China also. From China, we'll have their CPI year-on-year figure, and we'll have the same CPI results over from the US. And that's where the key focus is going to be, okay? Now, the consumer prices from the US is going to be the big news, and that's going to be followed by then the US producer price index, right? Producer prices on Thursday, and expectations are mostly for a slowing with there are some exceptions of the annual CPI core. Okay, and if that comes in line, then certainly that's going to be a strong boost for the US economy. Other than that, US data-wise, we have will include. I think we have now monthly Treasury bills. We'll have the monthly Treasury bills going to Friday. Then we come over and focus in the UK. So on Friday, we'll have sort of some key batch of data being released in the UK, which includes the first look at the second quarter GDP figures. Okay, so now we know that the US is actually in a technical recession, right? Whether that's the definition or the true definition or not, I'll leave that to you to define. Okay, but ultimately, they are in a technical recession, but not a real recession, shall we say, right? Now, will the UK follow suit? Okay, will the UK follow suit, being also sort of, regarded as a technical recession? So we'll find out on Friday. So on Friday, we'll have more data from the UK, mostly focusing on obviously the GDP results going to come through, but as well as that, we'll have industrial production, merchandise, trade data, for June as well. Right, so that's sort of the key focus there. In addition to that, you're going to have European as well, so European sort of, industrial production as well. And then to top things off, we have the consumer sentiment. Okay, University of Michigan consumer sentiment is what we will close on for the week. Now that covers all sort of key macroeconomic data for the week ahead. Apart from that, as I mentioned, yeah. Now, we've seen in the US stock markets, I've already mentioned that we've seen 3 straight weeks of gains, even though they've not been strong impulsive candles, but we've seen still seen gains. And that was largely due to the impetus that we had from the earning results. Okay, in the last few weeks, we've had earning reports coming from all major sort of companies. Now, from the S&P 500, 80% of those constituents have already reported, and the vast majority came in much better than expectations. Okay, so vast majority have come in better than expectations. Okay, I think the clip so far is around 78% have beaten their expectations from what I've researched late last week. So, and that's led to that impetus of the continuation of a bullish move in a bear market. Okay, so we are still in a bear market territory, or we've just seen a bit of a bull move occurring in the last 3 weeks. Question is that likely to continue? We'll hear more when it comes to inflation reports, UK GDP results. We'll have the final week this week with almost pretty much the final week of reports from corporations and some consumer reports, consumer sentiment reports to be expected there as well. Okay. Now, as I mentioned about US inflation, this is something to sort of just take note here, right? So US inflation is poised to cool. Okay, and the reason behind that is, of course, the lower energy costs, right? Or may lead to a cooling in the CPI results, right? That's now the estimate is, you can see the fall there. That's what that is what the estimate is at this current moment. Okay, so we're expecting a cooling off in inflation. Now, this comes in higher, that is certainly going to be a concern. If it comes in higher than the estimate, that is going to be a very strong concern for the Fed members. Okay. In addition to that, let me just have a quick look if I have another stat to show you. Now, why do we believe that there's going to be a cooling in the CPI result, the US CPI result? Well, it largely comes down to the influence it has from commodities. Okay, especially with the US, the inflation report has largely been driven, these high numbers of inflation reaching 9.2, 9.4, sort of these elevated 9% levels, and not being back, coming back to sort of the defined levels by central banks around 2%, right? Is largely due to the price of commodities that we've seen. And now all of the key commodities have begun to cool off in their prices. So we've seen gasoline moving lower, iron ore, soybeans, and wheat. Okay, so both hard and soft commodities have begun to cool off, which also is one of the key reasons we could see a much better than expected CPI result in the US, but not in Europe, where a lot of the focus is going to be energy related, okay, in regards to their CPI reports. It's energy related, and the cost of living crisis is certainly in the background working there as well. Yeah. And then finally, let's show you one more chart over here. Now, it's worth noting is that there is, the key focus being is, are we heading into a recession? Now, as I mentioned, the Bank of England already reported that, we're going to, by the end of this year, we'll head into a recession. It could be a long looming recession that could last 4 to 5 quarters. The US, the Jerome Powell, in his press conference came out shifting to a dovish view, where they're now more data dependent because of the recessionary fears that they have. Even though we had a lot of Fed members, rebuttal that and state, no, we're still inflation focused, but still we're seeing recession in the background looming. And the question is, with the GDP in the US coming in for 2 quarters at a negative rate, whether it's the definition or not, there is a technical recession, but not a real recession. Now, will that translate into a real recession? One of the key metrics you viewed as an early warning signal for a recession is looking at the bond markets and the yield curve and looking at 2 different yields, short to long-term sort of durations, right? And when they invert, it leads to an early indication of a recession. And that's what we're seeing here, okay? And you can see historically, every time it's below the zero, right, below the 0% level, every time that occurs, that sort of, takes place before a recession occurring thereafter, okay? So it can be regarded as an early inclination of a recession potentially. So we saw that taking place in the 1990s, we saw that taking place in the 2000s, as well as the 2008 global financial crisis. It did also occur just before the pandemic recession, right? Even though it's one of the shortest recessions in history. But again, we're heading in the same direction, okay? So we've certainly seen already the 10-year and 2-year yield inversion, okay? But do note, that's not the most regarded one. That is not the most regarded one to view. The actual most important one that's regarded by the Fed, is the 10-year yield minus the 3-month yield. That's the one that they view on an ongoing basis. And that's not quite in the recessionary zone yet. Okay, so it's not flashing recession yet, but it's heading south, should we say. It is heading south, so it is certainly heading lower. Question is, will that sort of meet that level? So that's what you need to look at next, okay? So don't just look at the 10s and 2s, look at the 10-year minus the 3-month yield as your indication that what the Fed are watching at the same time for a potential recession. Okay, so that covers some of the sort of the key charts there. Now, looking through some of the sort of the markets that we want to review, we've already touched upon some of the equity markets, both US and European markets, and that's where my primary focus is. Looking at some of the commodity space, okay, so just looking at gold upon sort of reaching that key level of support that we saw taking place 18th of July, okay, so 18th on the weekly. If I go to the daily time frame, we'll have a much better reflection. Yeah, so 21st of July. So hitting the low of the 21st of July, we've seen a continuation in that bull run, that bull recovery taking place, sort of testing the 1790 handle and just really hitting the resistance of that 1800 figure. Okay, so that's a key resistance zone. You can see it's been previously tested on the 16th of May, as well as the 31st of Jan. Okay, so that's a very strong level of resistance ahead for the price of gold. Now, if the recessionary view continues to take grip, we could see gold prices continue to rise. If we start to see that soft landing is beginning to emerge and the recessionary view is less likely, then certainly we could see, this continue to maybe trade sideways or come back to those prior lows. Okay, so that's the sort of the key view to take when it comes to looking at gold. And naturally, with the geopolitical risk of what's taking place with the tensions rising between US and China over Taiwan, that's another sort of key area to focus on when you're looking at the price of gold. Looking at oil markets, again, we've seen the move lower. I've already covered a bit of the fundamentals in the oil price. So we're looking at crude oil, not Brent, we're looking at crude oil here, reaching close to a low of around the 88.50 handle, 88.50 handle. And sort of finding some sort of level of support there. Question is, are we going to continue to the downside? That's, again, linked to the recessionary fears, but also we've got to view what the US are going to do in regards to their reserves, because that comes to an end leading into, I think it's towards the end of September, early October, okay? Now, that could be the next leg higher potentially if they, are unable to push out a lot of their reserves into the markets. So yeah, there's still sort of lots of questions to sort of view there. Looking at some of the currencies, overall. Now, with the currencies, what I would suggest there is certainly looking at the dollar index. The dollar index is a good gauge to view, on sentiment in the markets, and just looking at maybe moving up to the daily time frame. We had a move lower in the dollar strength that we've seen of late. Okay, so we've certainly had a lot of dollar strength of late, and now it just came back to sort of hit a support level, and there is still some impetus sort of to the upside. We are in a strong trend. The trend is your friend, as they say, so don't be intuitive to counter that trend as of yet, unless you start to see lower lows and lower highs being formed. Okay, but we've reached an area of support. Now, is this what's going to lead to the next leg higher? It does come back to the fundamentals. Okay, it does come back to the fundamentals. What could bring it to an end potentially is the inverse correlation it has with equity markets. Now, if we see equity markets to continue to the upside, then certainly we could see dollar cooling off a little bit, maybe moving sideways, maybe sort of recovering back to sort of the 100 mark. Okay, and that's what you're going to look at is the view of what is the Fed likely to do? Are they going to raise rates at the rate they have been doing, or is that unlikely? And that's where we may see more impetus in the equity markets, right? So we do know that from a money flow standpoint, a lot of the money's been taken off the table and there's a lot of cash reserves amongst money managers. Now, are they going to begin to deploy some of that capital back into the markets? Yeah. Let me switch over. Yeah, so that will be sort of the key focus when it comes to currency markets. Looking at Kryptos, right? So we've certainly seen Ethereum outperform in the last few weeks in comparison to Bitcoin. Okay, so we've seen sort of, certainly a much aggressive or stronger gradient in the rise of the uptrend that we've seen in Ethereum than we have with Bitcoin. And that's, leading into within a week or so, we're going to find out about the ETH merge that's about to occur, right? So that's sort of the highly regarded view that a lot of that rumor is being priced in now into markets. So there's a lot of speculation taking place in the price of ETH. And overall, the crypto space is starting to come out of those lows. Okay, we've seen sort of much better performance from the crypto space. And is that why we're seeing an improved sentiment, right? So as the sentiment improves, that the equity markets are coming out of these lows, and they're maybe put in those lows and they're bouncing higher. That's also improving the sentiment in the crypto space also. Yeah. So yeah, Bitcoin is sort of testing the 24,000 sort of levels, and just shy of that now is around the 23,350 level. And it's sort of hit this key level resistance 3 times now. So it hit this 3 times now, this 24,200 mark. And the question is this going to be follow through? Is it going to be a breakout? We had a false breakthrough initially, but again, we need a strong sort of close on the higher time frame through that level. Yeah. Okay, and that wraps up this weekly market analysis. Hopefully, you've got a good insight and a good way of knowing how you want to pivot yourself when it comes to trading the markets the week ahead. If you have any questions, please feel free to send over a question through to hr@alphachain.co.uk, or put in a like, subscribe, or your questions in our YouTube channel. Other than that, enjoy the upcoming trading week, and I'll see you next week. Take care. Bye-bye.